Hello YouTube. Today I'm going to be going over this dividend portfolio, and just a quick disclaimer, this is not financial advice. I am just showing one strategy that can be done in a larger portfolio. Just trying to show people how this works, and there are other videos that go over some of this strategy, but overall this is about purchasing assets that make you money for passive income. And that is what I've been building. I have auto purchases on, and there's details. And I'm mostly making this video for two friends of mine, you know who you are, to show you some things about how this works. So I have some charts on here, and it might look like a lot, but that's okay. I'm just going to break some things down real quick. And I've probably told you that the idea is to purchase assets, which is funds. I'm going to look at the funds with you. Purchase funds that will pay something called dividends. If you've been watching this channel, I'll highlight this one. It's called IWMI. It's a brand new fund that I just started buying. I've been looking for new ones that I like, and it's IWMI. If I go to Yahoo Finance, this is it right here. It's a Russell 2000. It's similar to some of the other ones, except it's diversified into the Russell, which is cool. And it's got a great yield of 14.3% minus the expense ratio. 14.3%. I like that. Um, these are all the funds that I hold in this column right here. Um, oops. And you can feel free to check them out on your own time. This column right here is the basically the annual yield. So what that means is if you buy this fund, you can look at this like a percentage, right? If you buy this fund, the top one is 10.2%. If I buy this fund and I hold it for an entire year and the price doesn't move at all, I will get paid back in monthly dividends 10.2%, meaning if I have $1,000, I take 10.2% of that. I should have pulled up my calculator here. Give me 1 second, I'll pull up the calculator. Okay, so what that means is if I had $1,000 and I multiply it by 10.2%, I would get paid $100 that year, and it's usually paid monthly, so then I'll do divided by 12. So if I had $1,000 of this fund, it would be $8 a month. Make sense? So what I want to do is I want to buy, this column here is percentages. I want to be buying funds that pay me back, or pay me dividends by holding them. And some of these are higher, like this one is 19%. Maybe asking, why would I want to hold all these different ones? Well, this one's 10%, this is 8. These are smaller ones. They do different things, and basically it's always good to be diversified. These ones at the bottom pay very high yield. This is 65%, and this is 121%. These are very high risk positions that you may or may not want to do, and as you can see, they're not my entire portfolio. This column over here is an estimate of the amount of my portfolio that it is. So JEPQ is 9.6% of the portfolio. SPYI is 13% of the portfolio. And by adding all of these up, I use this website to get what's called an average weighted return calculator. Um, and so you put all of these in, and my average yield for the whole portfolio with weighting things is about 22.9% for the whole portfolio. Um, that's this weighted average down here, including these ones. This chart on the right, these are the annual percentage yields of the different funds. So I can see where I didn't include the high risk ones in here because it would throw the chart way off, but the average of all these ones is about 10%, and some are lower and some are more, and I hold different amounts of them. But this grouping here is a grouping minus these ones in orange down at the bottom. These contain a good mix of, I think they contain a good mix of higher yield to higher risk and lower yield to lower risk funds. And if I add all these up, I'm getting about 10%. And again, I want to hold a variety because that's just called diversification. And to wrap this up, where are we today? Um, so again, my weighted average return is 22%. Um, so what I've been doing here is I started this in April and I've been tracking the payments. So this column here is the monthly total. Everything over here to the right, I'm just recording the dividend payments. So like in this yellow row, I got a dividend payment of $28. I got a dividend payment of $12. There's a $4, $11, and so on and so on. Okay. This monthly total is what they have added up to so far for October. This is probably going to be the last video I make for October. So right now, I'm at $328 for October. That's what this chart on the right is. This is the monthly total and it's going up and to the right, but I have been purchasing into these funds every week. So I'm trying to grow this dividend, and these payments I can take as cash or which is an option. What I'm doing right now is this cash that comes in, I just have it cycle back in and it just continues to buy more of these funds automatically. And then this column here on the left side, this is the grand total for the year so far. So far, starting back in April, we brought in $948 and we're up to $328 monthly. And like again, I just found this is a new fund, IWMI, that I just got. That's a 13% return, so that's pretty cool. And the next thing I can do is I can say, okay, well, I may get may since the last video a couple days ago, I got more dividends, right? I got a $36. That's these ones in green. I got a $36, a $13, a $1, 28, and $13, all in the last 3 days. And that pushed us over the $300 mark. Now, let's say I stopped buying anything else for the rest of the year and for the lifetime of this portfolio. What I can do is I can say, okay, so let's say I am making $328. I'm going to use the calculator. I'm making $328 a month, and then I do times 12 for 12 months. It should be $3,900 per year in dividend payments. Some people don't start to do this stuff until it's like retirement, right? Like maybe you're saving money, 10% of your paycheck your whole life and putting it in, regular stocks, ETFs, whatever. And then when you're ready to retire, you're 55, 65, you move that money slowly into dividend paying because I want this monthly payment. I want this $328 a month. I want to grow it to $400 a month. I want to grow it to $500 a month. I'm holding these funds, okay? This is what one of them looks like, right? IWMI, and it does fluctuate up and down like a stock, but over time, you can look up, it has this yield. That's what it's paying the yield is for the whole year, and it's paying that usually on a monthly basis. Some pay every 3 months, most pay monthly, some pay weekly, but that really doesn't matter. We're looking at the yearly. Um, so that's pretty good. The fund itself would have to drop 13% for me to break even. But this is a multi-year strategy, so we're going to be just fine. These ones down here have very high annual yields. Um, so depending on your risk level, I wouldn't necessarily have them, but the thing with them, they have very high yields, but the fund itself has risk of dropping in value. It does bring my weighted average return up higher, um, but they are riskier. Main thing is, some of these are very low risk. CLOZ is a 7.4% annual return. JAAA is a 5.4%. This one should be extremely low risk. It doesn't grow as quickly, but I've got a variety. So let's see. Okay, we did the annual. If we made 328 per month, almost $4,000 a year. So if I do nothing else, I should make an extra $4,000 next year. 328 $328 a month is pretty good. That could, if I didn't buy back into funds with that and just took it as a check. Now we do have to pay taxes on this, so you always have to remember that as well. But yeah, this could be substantial. This could be groceries. This could be part of a rent payment, right? So that can be pretty powerful. The other thing we can do with this is, so we can also say, okay, what if we got it up to $400 a month and then we did times 12 months? We're creeping up closer to 5 grand a year. So it entices me to grow this. The last part I'm going to go over is this is called a compound interest calculator. You can find this at um, investor.gov. Just go on Google and type in compound interest calculator. So this seems like a big thing, but what we're going to do is we're going to put in our initial investment. So I'm going to say $20,000 to start. You can play with these numbers like all you want. It's kind of fun. There's a cool tool to like run different numbers. Let's say we're starting with $20,000. Monthly contribution. What can I put in from my own paycheck per month? Let's say I can do $100 a week, so I'll do $400 a month. I'm doing starting with 20 grand because that's about what I have. Length in time in years. This is just going to calculate this table. It doesn't really matter what we put in here. I'm just going to do 30. I'll do 30 years. Estimated interest rate. So the interest rate is the same thing as the percent yield that a fund pays back. So these do have different yields, and what I did is I averaged them out. And without the high risk ones, it's about 10.1%. So we'll use that. But with the high risk ones, it's 22, which is incredible. But just to be conservative, let's do, I'll do 10.1%, 10.1. Then it asks for this interest variance range. This lets you do a comparison, so I'll put in a 1 there. We can see what 11% does and 9%. It's going to ask compound frequency. This is, we just do monthly because most of these pay monthly and then they buy back in. The compound part is that when these dividends come in, each one of these little payments, they buy back into the fund. So you get, the idea is you're going to get this snowball effect. I'm going to click calculate, And this says with the 10.1% plus I'm adding $400 a month for the life of it. We'll run it one more time as if I'm not adding $400 a month. Starting with 20 grand, this says in 30 years from now, I'll have $1.3 million. We can see on this chart kind of how it's growing, and it gets this curve upwards. This is the part where they always say the more time that you have on your side, the better this is, because this is the 30 year. But if I did 40 years, it would really start to like accelerate upwards. Um, so this is the amount in 30 years. What I'm more interested in is if I do show table, it will show the difference between each year. So if you can see on the left, it says year 0, year 1, year 2, year 3. So year 0, I have 20K. We're adding $400 a month plus the 10.1% growth rate. By year 5, it should be 64K. By year 10, it should be 137K. So I want to look at like what is this going to be at year 20? 457K, and let me make this a little bigger if I can. And what would then, if I stopped adding money and stopped buying back in, what would my dividend that year be? That's what I want to know. And we can do some estimates. And essentially, if you're getting close to $1 million, it should be paying $10,000 a month. So one way I'm just going to calculate that is, let's say I had 100 grand. I did this for a few years. I mean, this says if I do this for 8 years, I'll get up to 100 grand. And then I drop my monthly contribution to nothing. And I'll just hit calculate again. Starting with 100 grand, this says the next year I would have 110 grand. So I'm going to take this 10 grand, 10,500, put in a calculator and say, okay, that's per year. If I do divided by 12, I'm getting $800 a month. That's pretty good. If I stopped adding money once I got to 100 grand, it's just going to keep compounding because that 10 grand is just buying back in. Where this gets more interesting is when we get up to like the 600 grand point. The difference between this is 60K. So that would be like getting 60K a year, which is $5,000 a month. Obviously, there's inflation, but I'm interested in what is the point at which it can cover, all of my regular expenses. And I can start to calculate that with some accuracy. If I weight this portfolio, like I said, my average is 10.2 between all of this. If I weight my portfolio higher, let's say I weight it so it's more like closer to this 13% on average. We'll put in 13% here, starting with 100K, no monthly contribution. Now this is saying in 30 years you'll have 4 million, and I can see, okay, in 14 years it'll be generating 80K per year. Divided by 12 is 6,600 a month. It should be generating. So this is some of the type of stuff that you can do, and you start to get an idea of like, if you're 30 years old and you started doing this, let's say you just start with 10K. Let's say you start with 5K. That's all you have. And then you work really hard and you contribute 500 a month to this and you're 30 years old. What are you going to have when you're 60 at with this strategy? This says you'll have 2.48 million. At what point could you take the gas off and stop contributing? I would say, I mean, you can basically calculate what your future like retirement income would be, right? This says at year 20, the difference between these two numbers is about 90K. So you could get to year 20 if you're 30, then when you're 50, you would be able to um, probably just coast at this point because you're making 90K a year um, passive. Cool thing is, the more time that you have on your side, if you can wait longer, the difference between year 25 and 26, assuming you're still adding $500 a month, but you started with 5K, the difference between year 25 and 26 is almost $200,000. And let's do, I know it's more like 190. Of course, we've got to pay taxes, but let's do divided by 12. Now you're talking about 15 grand a month. We can actually try to figure out at what point it's paying 10 grand a month. But again, we did all the work up front, and this is how fast it'll show you how fast it's going to grow. We can also look at, what if I already have a retirement account what if you're in a position where you've already saved, let's say 200K, and you're still adding. This says in 30 years you'll have $11 million. Of course, if you have 200K, you might not have 30 years, but the cool thing I like about this is it shows this table year by year. So, say you've saved 200K and you're still working, so you're contributing. In 10 years, it'll be paying back 100K according to this per year. So that's getting into your close to 10K a month. If you had 20 years to build this, now you're getting into like, this says 400K a year. Let's say you had 200K and you didn't know what to do with it and you didn't add anything. We can calculate that. It still says you're going to end up with 9 million. This is starting with 200K and it says monthly contribution 0. Still says 9 million in 10 years. And if you had 200K and you did nothing, by year 10, this says between year 10 and 11, the difference between this is exactly 100 grand. So if we minus taxes, we'll call it 80 grand, and then you did divided by 12, you're making $6,666 in passive income that you could stop putting back in at that point and just live off of. So the idea here, oh, I moved this, didn't I? Make this a little bigger. This year, we're going to end the year with, it looks like, let's do 948 plus, so that's October, so let's do plus November. Let's assume it's the same, 328. plus 328. We should end this year at with $1,600. And then 328 times next year, we should make 4K by the end of next year, which is pretty cool. And basically, we're going to get to watch both of these charts, especially the one on the right. This is the monthly dividends. We're going to get to watch this grow up and to the right over the next few years and see what happens. So, if you know, I probably made this video particularly for you to show you a bit of how this works. We want to buy, these are the funds, we want to buy assets that pay us back, and that is the goal.